You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Thank you for joining us on Minds of Commercial Real Estate. Today we have Tony Valte again with Tax Mitigation Group. This is part 2. Today we are going to talk about how Tony can help with tax mitigation on personal returns. Tony, thank you for joining us on the show again.
Kamyar, I do appreciate the opportunity to continue from our prior discussion and at least get into from a high level to a more detailed level so the viewers can see structure, Schedule K-1s, Treasury regulations, and the such. So I do appreciate the time. I was hoping the general counsel for my firm, Keith Elder, by the way, as attorney in Woodland Hills. So right between you and our offices,
Sure.
Been a attorney for 31 years, primarily transactional too, probably for the last 15 to 20. And I've been working with him over a decade too. So at least the viewers see that you're in California and I'm in California and my general counsel's in California. Even though we serve clients all over the country, it's important for them to at least see and know the individuals involved. But again, thank you for the time.
Absolutely. So we do have the 2024 tax extensions for the personal and corporate coming up. This is the final deadlines, which are, correct me if I'm wrong, which would be September 15th for the corporate and October 15th for the personal.
Yes. And this is primarily what I'm going to be discussing today is for the 2025, tax season. There's not much in terms of a lot of the tax mitigation techniques, unless you're using, tax credits or anything of the such. You can't go back to 22, 23, or 24. Everything has to be done and completed and planned for the 2025 tax season, which for my industry in tax mitigation, that's definitely when I'm at my most busiest, because most of my clients, even though I can do liquidity events like business sales, or if you're doing Roth conversions or selling stocks, those can happen anytime. Most of the clients that I work with, they definitely come and reach out third quarter, fourth quarter, at least before my cutoff date, of which is right around before Thanksgiving, because we need time. Can't come at me December 31st and think I can work magic happen. I wish I could, but run if I could do it. You have to make sure that not only do you work with us, but if we're going to generate losses to offset gains, it has to be done properly according to the code and the Treasury regulations.
So let's go. Where would you like to start? So we're going to start with the 2025 new bill, the big, beautiful bill that was just recently passed. And which aspect of it would you like to go into more detail?
Yeah, actually, this is going to be a more detailed, especially for all the viewers that came to our last podcast, which we're excited about. I know you're excited about too. This is going to be part 2, but I'm going to share several screenshots so that the viewers that came to that first part, but then also even the new viewers that come now, they're going to see a more detailed look at the strategy that we do for income tax. But getting to the beautiful bill, just overall, it was a big win for my industry and taxpayers alike. And not just tax mitigation, but no tax on income, no tax on tips and certain different things that the bill provides for. But even in the tax mitigation space, we're able to see a lot of benefits, like even with bonus depreciation, which is at 40% just last time we met, right?
Correct.
And now it's back to 100%. So we can definitely get into more another podcast just on the beautiful bill, because there's so much that was laid out, but even so much within the bill that we need to be able to discuss for clients just across the board when it comes to tax mitigation.
Absolutely. So which do we start with
Yeah,
first?
let's get into taxable events. We're talking if you sell a business, you sell stock, you sell real estate, any type of taxable event like that, you're gonna face more than likely capital gains taxes. Okay. If you're in California, where you're located and I'm located, capital gains is 33.3%. Yeah, it's 20% to the Internal Revenue Service, 13.3% to the Franchise Tax Board. It's not ordinary income rates, but when you're selling your business or you're selling a legacy or you're selling a stock, the last thing you want to do is give 33.3% to the taxing authorities. And working with, my firm and working with Keith, we can get that capital gains tax rate. Let's say here in California, even though it applies to all states, although some states differ in terms of taxes, obviously, but we can lower capital gains tax rates to as low as 15 to 16%, which is huge, especially in California. If you're selling a $1 million business or $1 million in stock that are longer than a year of holding period, on $1 million, you're giving out $330,000 to the tax authorities. Working with my firm and our special allocation strategy, we can get that down to 15, 16%. So we're essentially reducing the tax burden, tax cost in half, which is huge in terms of tax savings, because all we're doing here is preserving wealth, not growing it. We're helping clients keep more of what they earn, especially now, though, when we get into the planning season, as individuals are going to be, they've already filed their 2024 tax returns, or if they had an extension, for example, and they're going to be filing the tax returns for 2024. Obviously, there's not much we can do there unless we do tax credits. But for those that are already planning, and it's a majority of my clients that are already planning for 2025, an ordinary tax rate. So if you're a business owner and you're receiving K-1s, or if you're a 1099 business income owner, and with the exceptions to W-2, there's strategies that we can do there. We can lower the ordinary income tax rates using the same strategy, but going, say, from 37% for states that have no income tax, or in California, it's almost 50%. We can lower that down to 20%, which again is an even better savings for annual, earned income. So if I may, I'd like to share a couple of screenshots for the viewers to be able to see, and I can go into a high level overview, but a little more detailed than part one that we did in that first podcast. So as I was saying in the beginning, I use Internal Revenue Code 704B and the Treasury regulations, which I'll show here in my third screenshot. But no matter ordinary income tax or capital gains, I utilize this same strategy to get capital gains down to 15, 16%, ordinary income tax for earned income, whether 1099 or I'd like to actually say W-2 or non-W-2, down to 20%. And this right here is a flow chart of what happens when you put the code and the Treasury regulations together, and how I actually generate the loss. Now that clients see, okay, well, I know for capital gains, 15%. I know with ordinary income down to 20%. Well, let's see how that journey goes from where they're at now to where we can take them and what that road is here. And this flow chart briefly discusses how that is done. So I use what's called a special allocation for partnerships. That's how the code would say it. But I call it the partnership special allocation, or for short, the PSA. That's the acronym in the tax industry for the professionals that work in the same space that I do. But all this special allocation is It's a partnership, the cell series partnership. So a typical client of mine, let's say a doctor in California, and I'll just use $1 million just to make it easy for the math. It can be done 1 million, 2 million. I have no ceiling. I was doing offsets of 35 million last year, 50 million last year, 2 million. So there is no cap. There is a minimum. I don't usually go below $1 million, but it's not a deal breaker. You want to be able to talk to the clients and see what you can do. So there's things that we can do even if you're below the minimum. But in terms of the goal is to take your taxable gain. So let's say, for example, my typical client, a doctor, makes $1 million a year, okay, in business income. If he doesn't do anything, $500,000 is going to the Internal Revenue Service. It's going to the Franchise Tax Board, 37% and 13%, maybe 0.3, respectively, between the IRS and the Franchise Tax Board. So my goal for the client is to generate a Schedule K1 loss that's going to equal that taxable gain. Fairly simple. But how does that get done? So I put all of my clients into a cell series partnership. Okay. And there is no other partners. It's my client and it's my trading partners at GFX Trading that typically does this business on their behalf and with their other partners, not just my firm and the clients that I refer to. So they're in this business. So my client, my typical doctor that's making $1 million comes to me and says, Tony and Keith, I don't want to pay $500,000. What can I do? I put my client into this partnership. My client is going to be 99.9% owner of the partnership. My trading partner at GFX Trading is going to be 0.01%. Don't mind the big discrepancy in the percentages. A partnership is still a partnership, no matter what the percentages are going to be. It's the allocation laws that come into play here. But once that partnership is set up, and that can take me 1 week to get done. It usually depends on the speed of the client. I don't need to be ahead of your earned income. Obviously, we can do this anytime. I don't take clients usually in December. It takes time to generate the loss. For your business exits or liquidity events, I usually do it right after the liquidity event happens so the client's liquid. I don't have them start with me ahead of time and come out of pocket. We'll come when the settlement funds close. But once the partnership here is established, we then, through the cell series partnership, and I'll just call it a partnership to keep it simple, the partnership then goes to our lender network and obtains a revolving line of credit that is equal to the loss that my client needs. So my doctor client needs $1 million loss. We then get a revolving line of credit for $1 million. That $1 million then goes from here back to the partnership. Now there's a note payable that is owed to the lender. But what happens is the partnership is a dealer in securities. So no licenses per se are needed because the partnership is doing it on their own. This is their business activity. They're not doing it for anybody else except for the partners within the partnership. What happens is that particular line of credit, that $1 million, is then used to purchase Forex trading currency forward contracts, and it has to be securities. As you're going to see in the Treasury regulations, this only works in this specific manner if the business activity is within the securities industry or sections 1236C, as it's commonly known as. But once we use that line of credit to purchase the inventory of the partnership, as you see right here, that creates the expense for the year. That's a loss. That loss then, according to the allocations and in the agreement is that the client is going to be allocated all the losses in 2025. So there's going to be a Schedule K1 that's issued from the partnership, and this is going to be ordinary. And you'll see in the Treasury regulations, it's not passive. By operation of the Treasury regulations, this is non-passive activity. No material participation is needed, unlike some strategies, like rental strategies that are available out there. Not only does the client have to put in funding to generate losses, but then they're a little burdened with time and effort. We have to get at least 100 hours of material participation, not active, but material participation to elevate passive to non-passive. The beauty of this strategy is, and you'll see here shortly, the activity is non-passive. So then we issue that Schedule K1 to the client. I provide it to the client or their CPA. Again, in this industry, I do not replace the client's CPA. I actually work with their CPA. The CPAs are great for compliance. They're great to make sure your risk is reduced in terms of audit and that you're putting and filing things accordingly. My job is to give the CPA the lower numbers so that tax owed on the return at the end of the day is going to put a smile on the client's face. Normally, the CPA is going to tell them, hey, you owe 500,000 in taxes. A doctor client's not going to be happy. The difference now is going to be when they do this strategy for the client, they put in 20% of this loss. So this $1 million, it's going to cost the client or my doctor client $200,000 to generate that loss. But I've eliminated their responsibility and obligation to pay the tax debt to the federal government, to the franchise tax board. And the state of California has no restrictions, say like bonus depreciation, for example, where some states don't comply with federal bonus depreciation laws. They have their alternates or they don't comply with it at all. That's not the case here. So my client that normally would pay $500,000 in taxes, they don't pay that anymore. So they're relieved of that $500,000 in taxes. But Kamyar, the client had to put in $200,000 into the partnership. So the net savings on every $1 million to a client is legitimately reduced to $300,000. That's the money they get to retain. And that right there is a win for the client itself because we've done our best to preserve the wealth. I'm not an asset under management guy. I can't help clients build their wealth. I can help the clients, depending on the event, I can help them preserve that wealth as much as possible. And that's where it comes in terms of the net tax savings. So most of my clients at the end of the day are pretty happy. And what I like about the industry that I'm in, Kamyar, I know exactly what the client's going to get. There's no guessing. I know in advance, and I call that value in advance. I know exactly when I'm talking to a client what their savings are going to be because that's the result that's going to happen. So this is how it's done. I'm going to show you another quick document.
Ask you a question, Tony, before.
Yes, please.
For the viewers, what are the chances of an audit, number one? And if they get audited, how involved do you get with that?
You never know when an audit can happen. The special allocations, this is an Internal Revenue Code, Treasury regulation. The IRS has seen these type of strategies all the time. Okay, so the chances of getting audited is pretty much the same for everybody. Obviously, whenever you do your taxes, if something's abnormal from the previous year to the previous year, there's a heightened chance of being audited. Okay, now where I come in is not what are the chances of you getting audited, what are the chances you're going to win and be successful. And I have 100% conviction that we're not going to have any issues in terms of an audit because the law firms that I consult with, or even the lawyers that I work with, or even my firm, we've been through our share of audits. We've been actually through one with one of the law firms I work with the Franchise Tax Board, and we were successful in all the audits so far. Doesn't mean it won't happen in the future, but we've been successful so far. Now, when it comes to backtrack real quick, if we ever did lose an audit, I'd have to go back to the drawing board. I'd have to see, where did we finally go wrong, or where did we go wrong? Is the issue, can we remedy it and change it to get it back to where we were, or is it not salvageable and the strategy is not going to be as good? So that's not the case at the moment. If the client does get audited, oh, I'm not going anywhere. My general counsel, Keith, he's not going anywhere. Or any of the law firms I work with, we're not going anywhere. We have a duty. Yeah, we have a duty to, whether the audit was triggered by this strategy, or for most of our audits, it was triggered by something else. But when the IRS or the Franchise Tax Board, who's actually more aggressive, when they come in, they're not looking at just one problem. They see, oh, okay, you just opened the door, right? So they're not just looking at this one particular instance. They're going to do a holistic view and then go in like forensics and then say, okay, well, what's this Schedule K1 loss you took here? We need to be able to justify that. And that's where your typical duties and obligations of those in the legal space, we have to be able to justify the position that the client took on the work that we did. And when the IRS or the state comes in, they look at two things primarily. Is this business, is this partnership that the client took a leveraged tax benefit from, is it real? Are the operating agreements real? Is there really income? Is there gain? Is there losses? Is the reporting real? And the answer, of course, is yes. We do it according to the revenue code and the treasury regulations. That's number one. Number two, the IRS and the state take a look at, okay, well, this doctor client right here, he only put in $1, but he got a $5 loss. That's the 5-to-1 multiple that we work with on ordinary income. They want to ensure that that revolving line of credit that was used, there's risk. If there's no risk in anything that we do, in any strategies, if there's no risk at all, you're going to lose the audit. So the revolving line of credit that the partnership obtains for the partnership is recourse only to the partnership. It's non-recourse to the partners, including my trading partner, GFX. The only issue that comes into play is your typical deficit restoration obligations within the operating agreement. And all that says is if there is ever a negative capital account, the clients have to put in money to make the account positive. So we've been able to get, not say around, but we've structured it to where we always keep the accounts positive, because during the life of the revolving line of credit, which is a 16-year time frame, no distributions are being paid at all. So we're never running into a negative capital account. But tax authorities come in, they want to see the reality, is what I call it, and they want to see the risk, the two R's. And if you can satisfy the two R's with the IRS or the Franchise Tax Board, your audits, and I'll take care of that, and Keith, but in terms of the establishing the two R's, your chances of audit success are extremely high. And so far for us, we haven't lost one yet. And if I did, I would probably be like, Kamyar, we have to have another discussion on, well, how we're changing things up, or better yet, the strategy that we talked about today, I can't offer anymore, because the last thing I want to do is put myself in jeopardy, put my attorneys I work with in jeopardy, and ultimately put the client in jeopardy too, and their CPA, because they trusted us to be able to put them in a position like this. And we don't charge extra when it comes to that. We also don't have any outside fees at all. There's no retainer fees. There's no hourly rates. There's no yearly maintenance fees. Everything's embedded in the cash outlay that the client puts into. So if my client, typical one, puts in $200,000 to get that $1 million generated loss, all of the fees and costs and structure and the positive capital account reserves are embedded in that amount.
Got it.
Okay.
Got it. That's great information. If you don't mind, we can go ahead and do another episode for your next document, and so we can get more in detail on each one, so that the viewers can, go ahead, go through
Like
this
that.
maybe more than once, and be able to, reach out to you for further questions and so forth. What is the best way they can reach out to you?
No problem. The best way to reach out to me is going to be my email address. Obviously, it's going to be Tony, Tony, last name's Valte with a V. So that's Tony V at tax, TAX, MIT, MIT for mitigation. So tax, MIT, and then group is GRP. So taxmitgroup.com, and reach out to me with any specific questions. And all I really need to know is ordinary, capital gains, what's the taxable gain? And at least by the time I do meet with the client or speak to them on the phone, I can tailor the discussion specifically to them. And I can also let them know where they're at now and where I can take them and get into more detail. But definitely stay tuned, viewers. Part 3. So this is going to be a good thing heading into this tax season, Kamyar. I like it.
All right. Very good. Thank you for the valuable information. Looking forward to part 3, and have a good evening.
All right, Kamyar. Thank you very much again.
Thank you.
Myself and Keith, we do appreciate the opportunity to be here.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.